Hey everyone, welcome to Bald Guy Money. I am Bald Guy, and we're going to start this week from the latest jobs report that was released on Friday because it ties in well with the topic of this video. And what that jobs report said is that the US jobs market is cooling off and unemployment is going up. So not much of a surprise for my regular viewers because we've seen this trend developing over the last year, not only in the United States, but in other developed economies like Canada, Germany, and even the UK, which has seen a resurgence in unemployment over the past couple months. And with these latest labor market numbers, I think it's safe to say that the US and global economies are starting to stagnate a bit. They're simply not growing like they had been, and when you factor in persistently high inflation, which remains far above the 2% target that central banks around the world are targeting, I think it's fair to say that we're experiencing a period of stagflation. But don't tell that to Jerome Powell, chairman of the US Federal Reserve. Otherwise, he's going to get mad, he's going to stick his fingers in his ears, and he's going to yell blah, 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 because in a recent press conference, when asked about the very topic of stagflation, he said, "I don't see the stag or the flation. I really don't know where that's coming from." And listen, you may be laughing at that, but the fact is he's not the only one who seems to be thinking this way, because immediately following the weak jobs report, the stock markets, and here I'm showing the S&P 500 index on the screen here now, took a pretty big bounce up, as hope for an earlier interest rate cut to save the economy came into play. And that bounce comes despite the very real issues we've seen with publicly traded companies so far in 2024, as many of them have reported less than spectacular earnings. Yes, Starbucks, I'm looking at you. So, watching this all play out, I got on X, formerly known as Twitter, and if you're not following me there yet, please give me a follow as I'm posting on that platform more and more. But what I got on there to say was this: the latest job numbers confirm we are in a period of stagflation, yet the stock market is rallying on hopes of a rate cut. The only things that should be rallying are silver and gold. The jobs numbers, this will lead to rate cuts and a drop in the DXY, so the value of the US dollar relative to other currencies, while earnings for these publicly traded stock market companies continue to suffer. And please let me know in the comments if you agree with that statement, because no matter what angle I look at this from, I just don't understand how a weakening consumer that is struggling to pay back debts on the backdrop of a weakening labor market will result in the stock market outperforming precious metals over the next 12 to 24 months. I just don't see it. From where I'm sitting, we are in the midst of a correction right now. Whether it's a major or minor one, only time will tell, but I know that many of you are seeing what I'm seeing too, and it's why I want to devote this video to a viewer question I received recently. And remember, you can leave your questions in the comments section of every video I do. I read all the comments, and sometimes I'll even dedicate an entire video to the question like I am right now. And this question came from Tarek, who asked me, and I'm paraphrasing a bit to capture the full scope of this topic, but he asked, if a banking crisis or market crash are really on the way, won't that lead to a crash in the prices of precious metals that I can take advantage of? And it's a valid question I know many of you want an answer to, so in this video, let's talk about how precious metals perform when banks are at risk, even when they trigger market crashes, and then let's talk about whether it makes sense to wait for the crash to buy metals, or if getting on a schedule, on a strategic purchase schedule, I should say, is really the best way to do it. Now, just before we get into it, if you're in the USA and want to buy silver or gold at a great price from a dealer that you can trust, please check out channel partner Pimbex at pimbex.com to see the amazing assortment of metals they offer. What you see here is just a small sample of what they have, and if you're buying the latest dip in metals prices, I am sure you will be satisfied with Pimbex. And for those of you who want to get some gold and silver in your IRA, they can help. Call them for a free consultation at the number on the screen to find out how. Just please tell them you came from the Bald Guy Money channel. So, getting into it, what we're trying to do in this video is answer the classic question, should I buy now or should I wait? And we're going to use gold as our benchmark for this video and start by examining what happens when a US banking crisis strikes. Now, there are 4 distinct periods I can point to going back to the mid-1980s that give us a fairly good idea of what gold does when banks start to fail. And just to be clear on the methodology, I take gold's starting price point from the year before the crisis started to provide a fair baseline price for gold moving into the crisis. And the first 2 periods marked here on the chart are associated with the US savings and loan crisis, which by most estimates went from 1986 to 1989, at which point the Resolution Trust Corporation was set up, which resulted in billions of taxpayer dollars being spent cleaning this mess up right up until about 1995. And what we saw during that crisis was the price of gold go from $317 per troy ounce in 1985 up to $381 by 1989. So a 20% move on an asset that had previously been in decline as central banks, most notably the Canadian central banks, hello to my Canadian viewers, my fellow Canadians out there watching this video, you're going to be very sad to hear that it was actually Canada that was one of the big central banks that kicked off the trend of central banks selling gold. But yes, that did kick off a selling spree of central banks selling gold that lasted all the way up until 2009 when they finally became net buyers again. And we'll talk more about that in a second. But what's important to note here as we look at this chart is that despite some flatness in the price of gold after the US government started using taxpayer money to backstop this crisis, and people became distracted by the collapse of the Soviet Union, which reinforced the power and might of the US economy, of the US dollar, and of US treasuries, the price of gold did not go back to pre-crisis levels. That did not happen until 1997, when central banks stepped up their gold sales, as you can see here in this image, during a period when many people mistakenly thought gold was a relic of the past and no longer had a place on the balance sheets of the world's major central banks. Now, moving back to our chart, we know that gold came back into style after the global economic crisis, which kicked off in 2007, and the US Federal Reserve proved that the United States was willing to print massive amounts of money at the expense of American citizens and US bondholders. And from 2006, a year before the crisis kicked off, all the way until the end of 2010, the year in which we saw the European sovereign debt crisis materialize, we saw gold run from $549 per troy ounce all the way up to $1,406 per troy ounce, which was a gain of 156%, which I have to assume was accelerated by the return of central banks as net buyers of gold, as we saw in the previous image that I showed. Now, I want to highlight the fact that with central banks buying gold instead of selling it, we never made it back to those 2006 opening price levels, because even as markets crashed for a 3-month period from September 2008 to November 2008, as many large banks used bullion banks to sell off gold to boost their liquidity, the liquidity of their banks, we still never got anywhere close to those 2006 price levels. And considering how the rules of bank equity have changed since the 2008 crisis, and for my Patreon members, I've done a full video on how those rules have changed if you're interested in watching that, we may not see a similar crash in metals prices this time around. Now, moving on to the final crisis marked here on the chart, we started 2022 at $1,800 an ounce. And once U.S. interest rates started to go up as the Federal Reserve abandoned their transitory, temporary inflation arguments, their position that the inflation was just caused by supply chain issues, once they realized that inflation was anything but temporary, we pulled back with the interest rates going up as far as $1,630 an ounce in October 2022. Nonetheless, we will use the $1,800 level per ounce as our starting point here because in 2023, the weight of higher interest rates started to impact banks, which had loaded up on bonds at significantly lower interest rates using depositor money. So the money that many of my viewers put in those banks. Sorry to break it to you. Now, I covered the specifics of that issue in my last video, so go back to that if you want to see a deep dive into this topic of why the banks are underwater and why this is such a big deal. But the fact is that the crisis isn't over yet. And so far, a little more than a year into the crisis, the price of gold is up 28% versus our January 2022 benchmark price. And I will say it again. With central banks loading up on gold still and the banking crisis far from being resolved, we're likely not done seeing upward movement on the price of gold. Although I do think we have entered a price consolidation period that may last all the way through summer. So I want to manage everyone's expectations when it comes to metal prices right now. This does not mean we are ready to hit higher levels right away. But it does mean, at least as far as I'm concerned, that you can forget about $1,800 per ounce gold. In fact, you can forget, in my opinion, about any gold price that's below $2,000 per ounce right now. Because if the 2006 to 2010 period was any indication of what a full-on banking and economic crisis looks like when you have central banks hedging against the US money printing that is intended to fix the economic problem, and remember, we haven't gotten to that point, not yet. We should be bullish on gold and silver over the next few years. And we should be picking spots to accumulate metals, meaning we should be picking spots to buy metals because we just can't be sure when the next catalyst pushing metals up will hit. And anyone who is waiting to go all in on gold, on a gold price dip down to $1,800 or even $1,900 per ounce at the start of this year, those people will tell you that sometimes waiting ends up costing you a lot of money. So, in the spirit of that message and those facts that I just presented, I want to show you two sets of data. And the first set of data is the pure US dollar value of 1 troy ounce of gold purchased at the average price over 15 years versus purchasing at the highest price each of those 15 years versus purchasing at the lowest price each of those 15 years. And this analysis is to show you that getting on a schedule, buying pullbacks instead of buying when the price is running up, is the best way to purchase metals. Because even if you make a few mistakes along the way and you buy the high price a few times, you will benefit over the long term. Because buying the average price of gold has yielded a 51% nominal return over the past 15 years, as you can see here. Buying the low price has yielded a 68% return. And even buying the high price of gold every single year has returned a 35% return on your investment nominally. And with central banks back on the side of people who are saving the value of their labor with gold, the future looks very bright for both gold and silver, by the way. And gold, at least in my opinion, has become the lowest risk mechanism to save your money. Now, if we switch over to this chart, which shows the same numbers, but adjusted for inflation, I would even go as far as to say that gold has also become the safest mechanism to slowly grow your wealth over time. With people who bought even the high price of gold, the number you can see here, the high price of gold every year, inflation adjusted, over the last 15 years, seeing a 9% inflation adjusted return on their purchases. And if you're concerned about premiums, because all of this was prepared on spot price, feel free to take out 3 to 6% on those returns, depending on the premiums you're paying, because even when you do that, you still end up on the plus side of things. So, Tarek, and anyone else waiting for the crash to go all in on gold or silver, my message to you is if you want to use physical gold and silver to protect the value of your money and benefit from the modest growth it returns over long periods of time, and that's not even mentioning just having a physical hedge to this overinflated paper derivative system that we exist in. What I want to say to you is get on a schedule, buy the pullbacks, and forget about trying to nail some magic bottom price. Because I deliberately left a viewer reply to this comment on the screen when I first showed it, because the comment is very true. If the spot price crashes based on massive paper selling, you may be disappointed in the reality of what the physical market has to offer. And if the paper market does indeed go down one day, you'll probably be a lot happier that you have the physical stuff as opposed to a paper claim to something that may or may not exist. Now, if you want me to do this same analysis for silver, let me know in the comments section. If I get 50 comments or more asking for it, I will do it in next week's video. And if you'd like to see this analysis versus the stock market, I can do that too. Again, let me know in the comments. Because none of this is meant to turn you off to other wealth building vehicles. I invest in stocks. I have certificates of deposit. I own real estate. And if you want me to compare metals to anything else, just tell me. Because this is a viewer focused channel. You matter here, and I want to know what it is that you want to see in the comments section. So please just let me know. And more often than not, you'll find out that I'm pretty flexible about the direction I want to take the content in here to deliver on what it is you want to see. And if you want access to the data I presented in today's video, you can join my Patreon. Link to join is in the video description as well as the pinned comment, because I will be posting all of this data in Excel format with all the calculations and price history in my Patreon tomorrow. And please remember, when you join, you get access to additional videos, you get my weekly newsletters, and my Patreon Discord, access to my Patreon Discord, I should say, where I am active every single day chatting with my patrons. With that said, that's it for this video. I want to thank you all for watching. Please remember, if you want to keep helping this channel grow, to have this content reach more people, leave a like, share it with your friends and family or anybody else you think might be interested in this content, and remember to subscribe. Thank you so much for watching this video, and as I always say at the end of my videos, take care of yourselves and take care of each other. Thank you again for your support. And goodbye.